Good afternoon, everybody. Welcome to our next session where we're going to be looking at how crypto asset market infrastructure is maturing to meet institutional demand. We're delighted to have such a great lineup of speakers with us and to have our moderator, Matthew Lempriere from BSO, who's going to be taking the session forward in just a moment. Just a few quick reminders in case you didn't join us for previous panels. And if you did, I apologise that you're hearing the same thing again. If you want to ask questions, please do put them in the chat box in the Q&A. And Matthew will field those questions towards the end of the session, so you get a chance to ask anything you want to ask. After this session, there's going to be a short break for networking, so don't forget to go to the lounge, Speed Network, or visit any of the sponsor and partner booths that take your fancy. And also there's going to be more speed networking at the end of the day as well. So if you're not able to do it now, then do join us at the end of panel 4 for some additional networking at the end of the session. So without further ado, Matthew, there's loads to chat about. I don't want to take up more than your allotted time. So I'm going to hand over to you to now take us forward with this panel on market infrastructure. Thank you very much for being here.
Thanks, Helen, for the kind introduction, and welcome to you all. First of all, to my panelists, but also to everyone listening and watching out there this afternoon. As Helen mentioned, we're going to be answering the question, how is crypto asset market infrastructure maturing to meet institutional demand? My name's Matthew Lempriere. I run the sales team for BSO. We provide a high performance and low latency networks and market infrastructure for financial services, but also now the crypto trading world. If I can ask Luke to please introduce yourself.
Yep. Hello, everyone. Delighted to be here. My name's Luke Dorney. I'm responsible for sales and strategic partnerships for Zodia Custody. We are a crypto custodian co-owned by a Standard Chartered Bank and Northern Trust. We are a result of a 4-year process that we've gone through our innovation arm of the bank, SC Ventures, which promotes innovation and invests in disruptive fintech. Essentially, we've set up a crypto custodian that is based in London and regulated by the FCA as a virtual asset service provider, and literally gone live within the last 4 weeks. So really looking forward to getting into some of the detail on crypto custody.
Fantastic. Thanks, Luke. And over to Sven.
Hi, my name is Swen Werner. I work in State Street Digital. It's the newest business division of State Street, looking at the development of our services around blockchain, digital assets, and digital currencies.
Thank you. And over to Lauren, please.
Hi, everyone. It's great to be here. Thanks for having me, Paul and Coinscrum team. I'm Lauren Kiley, CEO of Pure Digital. We've built a primary wholesale market in the digital currency space for top-tier banks to exchange risk. It's effectively a consortium-style setup, and it's completely bilateral, transparent, and bank-grade. And the other thing to mention is that underlying clients of those top-tier banks will be able to trade on the venue using their existing bank relationships.
Thank you, Lauren. And Max.
Thank you, Matt. I'm Max Bonan. I founded B2C2 in 2015. It's a trading firm that's now become the main dealer in the crypto market. And since 2020, we are part of Japanese banking group SBI. We've become the first dealing desk that's part of a bank.
Thank you very much. It's great to see you all here, and really the narrative of the panel this afternoon is that when the institutional participants first began to pay serious attention to Bitcoin and other crypto assets during the bull markets of 2017 that I'm sure we all remember well, they quickly came to realize that a market infrastructure that's primarily based on a retail market was significantly lacking the forces that rely on for their current services in custody, clearing, prime brokerage, even networks and data centers that they're used to using were still in their infancy, and that's if available at all. And things have changed in the last few years, with major players entering the market to fill these much needed roles. And in this panel, we're going to take a closer look at each of these functions and discuss how they're finally opening up to broader market access. So, Max, if I could start with you, B2C2 has witnessed 6 or 7 years of evolution in crypto market infrastructure. Can you summarize the landscape now compared to 6 or 7 years ago, please?
Yeah, the landscape was different, but it probably wasn't different in all the ways that people think it was. Certainly, we did not have an institutional market back then. It was all pure exchange trading, and there was no difference between an exchange, a custodian. There was no separation of duties there. But the market hasn't evolved that much either. If I look at the technology, it hasn't really changed. Of course, exchanges have gotten slightly faster, but mostly they've evolved to support more connections at the same time. Because back when Coinbase had 10,000 customers and compared to maybe 40 million now, the load on the system was very different, but they still operate as, broadly speaking, websites. So that hasn't changed that much. One thing that's really changed, though, that's just the scale of the market. It used to be that, I remember a meeting in 2015, a famous crypto VC visited my flat in London, out of which we were operating B2C2, and we were trading $5 million a day, which was a mind-blowing number. It was like 30% of all exchange volumes globally. $5 million a day was massive. But today, $5 million, there's trades that are bigger than 5 million, and certainly the biggest exchange and the biggest dealers, they do billion-dollar volumes on a daily basis. So that's really changed, and with it, the economics have changed. New players have been able to carve a niche for themselves. But that's it's really more the scale than the technology that's changed. And maybe another thing that is a little bit different now, but that's also perhaps the slowest moving thing in crypto, is just the adoption in terms of payment rails. Back in the day, it was the case that exchanges were using that to use dodgy payment processors to be able to accept funds, and that to change them every 6 months, it seemed, because no banks wanted to deal with crypto. It is, broadly speaking, still the case. The major banks don't want to do payments for crypto companies. They'll gladly take the transactional business in the sense of trading activity and things like that, derivatives, what have you. But in terms of transaction banking, in terms of payments, it's still pretty difficult. Now, the good thing, though, is that there's actual banks that have emerged specifically to serve the crypto market. I'm talking of banks like Silvergate. Kraken itself got a bank license not long ago. So that's really changed, but it's still one of the slowest moving parts of the market. We're still waiting for the day that Barclays, JP Morgan, and Citi will process payments for Coinbase.
Thank you, Max. And Sven, moving on to you, you and your team at State Street were keeping a close eye on these markets from quite early on, but understandably, I guess you had to move with extreme caution given a custody bank's fiduciary responsibilities. And how far do you think we still are from being able to tick all of those fiduciary boxes for your typical State Street client?
Yeah, I think that's an excellent question. Although, as a custodian, I mean, there are many risk types, and fiduciary risks being one, which really relates to the level of discretionary decision making you have. If you look at purely, for instance, custody, it's very limited, so it's not even on the top of my list of risk consideration. And Max, I think, described some of the challenges quite well that we all faced with when it comes to these asset types, and they relate to the underlying market infrastructure. So for me, it's really about some of the core aspects that, from an institutional perspective, you want that market to see, and at the moment they're absent or they are just in the process of developing. One, obviously, being institutional marketplaces. So we have Lonnie on the call. I think that's very important that there are these marketplaces where you can really have institutional to institutional trading and don't have a concern that you don't know the identity of your counterparty. That will be very important. Related to that is the ability that we can resolve for the pre-funding risk in crypto custody or crypto trading. So we will need a form of prime model, and there are obviously some of the other markets out there. There's an area around the question when these assets become actually a permissible investment for a certain type of investors, particularly in Europe. Think about collective investment schemes being subject to UCITS and AFMD directive. AFMD, so alternative funds, hedge funds, obviously have high level of flexibility. They can invest in crypto. with UCITS still a question mark. Are they allowed to do that? And if so, under what conditions? We still, and it's an open question around the whole capital risk framework, the potential treatment for crypto, and the ongoing Basel consultation, which sets out, at least in the current proposal, quite some punitive capital charges if banks were to get into that business. And the final one, Cash, quite interested actually, almost looking at this from another perspective. We're obviously right now in the crypto market having various solutions, including stablecoin, but in terms of the risk profile of these assets, they are obviously not comparable to cash held at a central bank, and that's typically how we would conduct a lot of the security settlement today. So we will also need more institutional geared payment solution, whether that is a wholesale CBDC or whether that is a synthetic CBDC in the form of finality that also can connect to these institutional marketplaces. I think that all has to come together. I would say a lot of progress has been made, but we will need to show this progress to regulators for them to get comfortable that regulated financial institutions can actually get into that business full steam ahead.
That makes sense. And actually, just an extra quick question on that. Do you think some of the industry bodies are useful in helping take that to the regulators?
Oh, absolutely. I think most of the time nowadays is actually being spent on these kind of debates. The problem is, I would say, sometimes what is it that you're asking for? So I think we all could easily agree that we need more regulatory certainty, but then how exactly, and is actually the proposal helpful and what you wanted? And then it's getting a bit more complex. But it is important, I think, from my perspective, that we put solutions or proposals out there and regulators can react to that. And then you know how far you can go. Unfortunately, it doesn't work the other way. You won't get all the details and you can build accordingly.
Thank you. Thanks, Sven. And Lauren, the lines between the wholesale and the retail markets have been quite blurred up until now. How important do you think it is to have these lines more clearly defined?
It's a great question, Matt. I would say the lines are still kind of blurred, hoping that initiatives like Pure Digital and some others out there are helping to make them more clearly defined. But it's incredibly important. I mean, the market, as we all know, was really kind of built from the bottom up, or in the opposite way of the way any other market has been built, whereas it's been very much retail driven and retail focused. And in order to have asset managers, pension funds, endowments, the less risk averse, they're not going to be mandated or be allowed to allocate to some of these assets, to trade them at all, if they don't have an entirely different infrastructure in place, and something that's very much bank grade, has bank grade KYC, AML, custody. The whole ecosystem has to be there. Otherwise, they're not going to have the level of trust or comfort to get involved at all. Even though you see now, I mean, some of the crypto native firms are relatively highly regulated and are have even gone public, but even that is not necessarily enough for some of these bigger players to get involved yet.
Yeah, absolutely. No, thank you. And Luke, likewise, firms such as Standard Chartered and Northern Trust, with solid reputations to protect, require absolute comfort to enter this space. And what have been the biggest challenges in getting Zodia off the ground?
Yeah, I think the kind of the major challenge is, and especially operating under a bank environment, the key challenge is establishing your risk appetite, and your risk appetite on a new asset class that has little or no institutional track record, right? When we were starting to look at this 4 years ago. And if you couple that with relatively difficult risk reward opportunities on that, and trying to figure out versus the risk and the reward of whether to actually enter into this space. But I think we took the decision pretty early to commit to this asset class, and as long as we could mitigate the risks that we identified, and I think we've taken a bit of a different approach to various other custodians. We've built our own technology stack outside of the bank's tech infrastructure, and we've basically built a business from scratch, a new entity, which is a subsidiary of Standard Chartered Bank and co-owned by Northern Trust. We needed to attract new talent, we needed to implement tech, put in the right governance and controls, and obtain regulatory approval from the UK regulator to operate as a virtual asset service provider. So, and the way that we've done that is that, and really the key challenges are the risks that we identified. And I think the first one is around technology risk. This is new technology required to support business on a blockchain. The bank's infrastructures, from a historic perspective, not able to kind of react to that very quickly. Do you build a new infrastructure yourself, or do you partner with fintech custodians to help you get there? And obviously we chose the latter route to make sure that, or the first route actually, to make sure that we've built our own technology infrastructure and are in control of that. I think that kind of the next two risks are really the fraud risk and the financial crime risk. And I think Sven was mentioning that previously. These are completely different risks to acting as a traditional custodian now entering into the crypto space, especially on the financial crime risk, right? You're dealing with anonymity of public addresses, and the bank's infrastructure and tools doesn't have a real-time infrastructure to be able to monitor blockchain addresses and understand who is on the other side of the trade for our clients. And not only the technology around the financial crime risk, but what are the controls you're putting in place around that ecosystem that you're building, and ensuring that the partners that you're letting into your ecosystem have been due diligence properly, are solid on AML and financial crime compliance, and making sure that you're letting firms into your ecosystem that your institutional clients would be comfortable with. And I think the last risk, and is probably the kind of the largest, or one of the largest risks around that reputational element of it. Being a bank, being highly regulated, and again, what Sven was saying around the fragmented kind of regulatory environment and not having clear direction from regulators around the world. How can we play in this space, and what are the things that we're really comfortable with? And the way that we got comfortable with that is that we would be focused on specific parts of the crypto ecosystem and ensuring that we do that well and that we're comfortable with. So starting with custody and supporting and focusing on a couple of different chains and coins, and build out our infrastructure from there. So a very methodical approach to getting this off the ground, but it has been a challenge to do that in a banking environment.
Thank you. And there seems to be some fairly consistent themes there around risk appetite, fraud, trust, regulations, technology, and scale, and then the old question of do we build or do we buy? And Luke, if I could just come back to you on something you were just saying there around the custody offering. There have been some new entrants, or crypto native new entrants coming into the market to provide some of these services like custody. But do you think the institutions would rather deal with a name that they know and trust and have an existing relationship with? Or do you think they are happy to work with these new sort of crypto native firms?
Yeah, I mean, I won't comment on the crypto native providers and their functionality and kind of their positioning in the market. What I can articulate is what we see from our existing client base, across the bank. And I think it's true to say that it's relatively easy to implement a custody wallet solution from a technology perspective, right? So, but I think the difficult parts to this are more around the assurances around regulatory compliance, the tightly governed risk and control policies, the legal structures that protect client assets, and building a safe ecosystem that I was talking about earlier. So it's not necessarily around the technology, and those crypto native firms are very good at that technology, but I think the kind of the heritage and the institutional trust that we've built up over many, many years comes with an expectation of assurances around compliance, regulation, governance and control, and ensuring that asset safety is paramount for our clients. And I think the devil's in the detail on some of the trust elements around, and this is some of the feedback that we're getting from the institutional clients that are not active in crypto today, but looking to enter into this space. they place a lot of importance on segregation of duties, appointing an independent custodian and a regulated custodian away from your exchange or your OTC providers. So making sure that you are segregating that duty of, I'm giving my assets to my custodian and I want my custodian to interact with reputable exchanges and OTC providers to move my assets. And as part of the custody offering, making sure that the beneficial ownership of that asset is really clearly defined. And that goes back to traditional custody and defining legal structures on top of your infrastructure to make sure that the beneficial ownership of asset is defined. And the way that we do that, and again, this was a non-negotiable, is making sure that we put assets, or we safekeep assets in segregated wallets on chain for our individual clients. We don't commingle any clients' assets, and I think that's where some of the crypto native firms have been setting up these businesses that are maybe a little bit more retail focused and not necessarily thinking about further down the line, where the institutions are looking at ensuring that their asset segregation looks and feels a little bit like traditional custody, even though it's on chain, right? So it's all about how you manage that from a legal perspective. And probably the last point is that regulatory compliance piece. We are a big advocate of the FATF guidelines around travel rules, so identifying the remitter and the beneficiary of every single transaction on chain. So really kind of payment transparency rules. It's true that the regulators have kind of not pushed this probably as much as we would have expected, but we do see that train coming, and we've built our products around that. And really what we're trying to do is push the ecosystem to make sure that that is moving at a good pace. And our clients are actually asking for that, making sure that they understand who they're receiving assets from and where they're receiving it and where they're sending assets.
Thank you, Luke. Lauren, could I come to you with a very similar question, really? Are you seeing people wanting to place their trust in more established names for things like prime brokerage, market data and other services? Or are people happy, are the institutions particularly happy to go with the more newer and crypto native firms?
Yeah, I think certainly for the more traditional space, they want to go to the incumbents. I mean, if you've got crypto hedge funds, maybe they're a little bit more relaxed about it. But in terms of pension funds or some of the bigger asset managers, and they also, not only do they want to deal with highly regulated institutions that they're used to dealing with, it's easier for them. They want to use, whether it's State Street or whoever it is, if it's Zodia, they want to be able to use that custodian, for crypto, but it's the same custodian that they've been using for all the other assets that they deal in. So certainly, there's definitely, from what we're seeing from who we speak to, the demand is that they would like to use the incumbent. They need to use a bank grade setup.
Thank you. And a question that I might ask to Max, actually leading on from that. The crypto assets market has now evolved to bring in some of these more traditional players. But is the market really still too fragmented to encourage greater institutional demand? Or do you think we are getting nearer to that?
First of all, what's fragmentation is the fact that there are many venues in crypto and possibly that there's no central clearing. But first of all, I'm not sure that fragmentation is bad. The foreign exchange market is very fragmented, and no one seems to mind it that much. I think there are powerful forces, economic forces at play that maintain fragmentation. For instance, price discrimination is a very big deal, and a lot of platforms are about creating that price discrimination. You look at Coinbase, Gemini, heavily regulated, retail-focused in the US. I think a year and a half ago, they managed to increase their prices, not decrease, even though there were more and more exchanges. So you see that, and on the other side, there's highly leveraged, crypto derivative exchanges like Binance, BitMEX. But those guys have been engaged more in a price war, and so you really see that fragmentation also kind of makes sense from an economic perspective. There's some people in the US that just want to buy 200 quid of crypto, and they want to do that in a safe manner. Probably they go to Coinbase. Now, if you're a day trader, you'd never go to Coinbase for your trading activity. The fees are too high, so you go to a BitMEX and FTX or a player like that. So that fragmentation actually does make sense in some context. And actually, when you think of it, I think we're not going to see necessarily less fragmentation because we're talking about regulation. It's quite possible that regulation will actually lead to more fragmentation. Every day there's a big exchange that gives up operating in a certain country because it's just too much. It requires too much focus to be licensed properly in that country. So, I think Binance has problems in the US. Not everyone is going to get a UK license. I heard from the FCA that 90% of applications are being rejected. So some players are going to have to stop operating in the UK. There's a new license in Singapore that not everyone's going to get. So I think just distributional strategies are going to maintain, and they're driven in part by regulation, that and access to banking, I believe. That's going to drive a lot of fragmentation in the first place. So I don't really see a lot of forces at play to lead to more aggregation. But at the end of the day, I'm not sure that's such a big deal. We talk about all the infrastructure that we need to get the big players involved. I want to say two things. First of all the big players, they're involved. All the players that need to be in crypto, they're involved. The biggest brokers in the world, plus all the names that everyone knows, Revolut, Robinhood, they're all in crypto and they're generating massive revenues of crypto. So when we talk about institutions, if we're talking about BlackRock and other asset managers, that's really the tail end in terms of actual trading volume. All the big transactional, like the players with a lot of turnover, they're in crypto. So we're really talking about the tail end, the most conservative institutions. All the institutions that need to be in the market, they're in the market. And in terms of seeing the emergence of something like a CCP, well, CCPs, that's also something that regulators really like, but it may be the case that in crypto, there's a path dependency that prevents us from getting the setup for the simple reason that the institutions that are in crypto today, they're comfortable with the way that it works, and it's not really clear that a CCP would add a lot to the mix. Maybe we'll see lots of different prime brokers. That's not really central clearing, but if there's one thing that maybe remains to be addressed, it's how do we extend credit between institutions? That's still, sort of neither here nor there. But I don't necessarily think that we're going to see the emergence of an actual CCP, and I'm not sure that's necessarily a bad thing. The crypto market, that structure got to be. I checked the BIS survey not long ago, and I think if you look at crypto volumes, it's like it's the 5th biggest currency in the world in terms of volume, just in front of the Swiss franc. So it's quite a big market actually, and the fact that it managed to get there without a traditional financial infrastructure, maybe it tells me that some of the infrastructure that we expect isn't actually really required, except for perhaps the institutions that have never dealt with anything beyond what they know. But I'm not actually sure, again, that those institutions would bring that much to the market in reality.
Matthew, can I just pick up on a liquidity point there? And that was just around the fragmentation. So, one of the key things that our clients are asking us, and it's a little bit of what Max was explaining there, is that as a custodian, these institutions are expecting us to work with different exchanges and liquidity providers to utilize their collateral that they've got, that they're holding at the crypto custodian, and utilize that for trading across multiple exchanges and dynamically allocate credit to those exchanges. And that doesn't necessarily happen today across the crypto market. It may happen in pockets. So that's one of the things that really, I think, from a fragmentation perspective, that definitely from the clients that we talk to, it's making sure that they're putting their liquidity to work and more efficiently, and not having that fragmentation across multiple markets.
Thank you. And Sven, I was going to come to you actually regarding fragmentation. Do you have a view on whether it's still too fragmented, or do you think that's a good thing?
Oh, well, I'm not sure it's a good or a bad thing. Obviously, we like markets to be liquid, and so you have the ability, even if there are different pockets of liquidity, that you can move across. For me, the aspect sort of what the area is looking at. So you could think of fragmentation in terms of how we make sure, and I think that's one of the themes that Max also alluded to. How do we, and where we really see an opportunity, how can we facilitate investments both in traditional investments as well, or traditional assets as well as crypto assets in a seamless, integrated fashion. And there you very quickly run into some issues. And it is, I think, a worthwhile question, not to say just because this is how we have solved for certain problems in the past and the crypto market has to adopt, but there are certain other elements that the traditional industry maybe have some role model to play. So one of the areas, for instance, is connectivity to all of these crypto exchanges. There are no real ISO standards. Everyone has their APIs, they have the different formats, definitions, they're changing. Also in terms of resiliency, so there, it's probably a different standard compared to traditional market, and that makes it quite complex. And areas we have solved for that, we're using, Swift connectivity to a lot of our counterparties. Everyone in the industry is used to it, is familiar with it. And I think the crypto market will benefit from some of those, if you want, harmonization layers. And they're coming. I mean, this is same about digital identity, that you have an established process, for instance, how we can be exchange and verify counterparty identities and counterparty settlement confirmations. There's a very robust process in the traditional world, and crypto obviously will need to have something similar. And for me, that's important. So, and then having a multitude of providers all coming with their own solutions and different take. I mean, that's a great thing, and I would welcome that level of dynamic development and alternatives in the market.
Fantastic, thank you. Yeah, I fully understand that. I think it's a very dynamic market, and the more people that offer innovative services, the more interesting it is. So, Lauren, that brings me on to the next point, which is that we're actually getting a few questions from the audience around this. But the whole subject of regulations, regulatory clarity, and how that is either helping or hindering incumbents from fully satisfying demands, and whether the regulators, will put anything particular under greater scrutiny going forward. So I was keen to hear your view, please.
Yeah, so look, I think it's all very positive that the regulators are becoming more and more and more engaged in the space. But of course, there's still a ways to go. And due to the lack of clarity, there are certainly some players that are sitting on the sidelines that just aren't allowed to get involved or can't touch it without that clarity. So hopefully we'll have more. I mean, even things as you look at the US, right, in terms of clarity and in terms of definitions, right, where is crypto, is it a security, is it a commodity? That framework really needs to develop, and hopefully it can progress in a much quicker fashion. I think because of all the attention on it at the moment, and the fact that there are companies that are now public, I think that there are many sort of cases or examples currently happening with the SEC that are at least shedding light on it and bringing it to everyone's attention that this must be dealt with. This is the way forward. There's interest. This asset class has staying power, and we've got to get the structure in place.
And can absolutely, Matthew, if you don't mind, just like to follow up, because I think that's an excellent point. For instance, on this classification, it has been around for so long, and people are like, why do you care? It doesn't really matter what it is. Well, it doesn't matter because it will drive how you have to tax certain profits, or if there's a fork event, etc. And coming back to really where we started, so what does it take for institutional investors getting into it? Well, you need that clarity, because otherwise you don't really sure how you have to process your tax applications. And so there's always a consequence of a consequence. And I think for me, it's a very good example, very practical to say why it matters. And it's actually as simple as it is in that, but there are different jurisdictions have come to different conclusions, and that's at the moment not helping.
Thank you. And Sven, I was actually going to come to you next to talk about the interoperability between the traditional capital markets and the crypto asset market, and how much of a challenge that still is. What is missing and what is needed to facilitate greater connectivity between these worlds. And when I say connectivity, I mean in two areas. So first of all, tokenization, but also physical plumbing and physical connectivity, which is obviously something close to my heart. But what is missing from joining these two worlds together?
Yeah, so I think the physical plumbing, I think that's the more complex part where we have to see how it's going to play out. And some of the CSDs have now made some very public statements around developing DLT-driven solutions. So we have to see if the market infrastructure that today is centralized can be a bit more flexible, decentralized, which will over time make it easier also to incorporate crypto. But the first point for me is actually almost more interesting or more prevalent, is to think about this holistically. So we have Europe, for instance, has MiCA as a proposed regulation for crypto custody, and other jurisdictions looking at similar things. Even UK is something around the crypto wallet provider, etc. So have as a bit of a licensing framework. But then these decisions are made without also looking at custody, for instance, or safekeeping from the asset management regulation. And so that at the moment is not aligned. So you use the term custody, and it can mean something very, very different, whether I'm looking this through the usage lens or through banking regulation lens or through MiCA lens. And that creates, if you want, a bit of uncertainty where you may, for instance, say, I'm already fully licensed as a bank to provide depot services, and these licenses are, in a sense, agnostic to the underlying asset. But then nevertheless, regulator may say, but if you now want to add a crypto asset to that process, I want, basically an extended licensing regime. That is at the moment a bit of a friction in the system, that you have to have a almost like per market decision matrix, what you can and can't do. And the answer, what you can and can't do, is not really consistent and subject to different, local preferences. I think that over time, what we've seen in derivatives markets, equities markets, where you take a global or at least regional view around some common principles, I think that is still missing. And that only if you have that, can you really expect, if you want, the same level of seamless integration between traditional markets and the crypto markets, because they are at the moment operating subject to, if you want, a different paradigm.
Thank you. And Lauren, we've got a couple of minutes left. The same kind of question to you, really. What do you see that's missing in addition to what Sven was discussing there?
Sorry, I can't hear you at the moment. I was struggling to hear the rest of Swen. I don't know if it's, can you just repeat the question?
Yeah, I was asking, what do you see, if anything, that's missing between bringing the capital markets world and the newer crypto assets worlds together?
Between bringing them together?
Yeah.
I mean, really, it's one of the bigger things is regulation and clarity there. But I do think, and I'm actually noticing one of the questions in the chat, I do think figuring out prime brokerage for the top tier banks, I think figuring that piece out is massive, because if you can set up a custodian and you can then figure out how to extend credit to some of these big institutions, and how you can settle and cross settle between fiat and crypto. I don't think anyone has quite cracked that yet, but I think it's coming soon.
Fantastic, thank you. So to my esteemed panel, thank you very much. We are just nearing the end of our session now. There's some real common themes from everybody's comments there around, as Lauren was just saying, credit and settlements, payments, trust. Regulation has clearly come out in nearly all the answers there, and just the appetite for risk of the institutions to do more in this market. And I think it was Max that said all the important players are already here. So clearly the market is working, and clearly there's great benefit from dealing in this world. So fascinating for me. I've learned a lot. Thank you so much to everybody. And I will hand back now to our host at Coinscrum. Thank you again.
Thanks so much, Matthew. And thank you very much to all of the panel. I apologize to anyone who asked a question who didn't get a chance to get it answered. If you want to network with any of the speakers during the upcoming break, then feel free to go find them in the speed networking and ask your question there. We're going to take that short break now, so grab yourself a cup of tea or coffee or catch up on your emails, and we will see you back at around 4:05 for our next session, which is going to be looking at regulation. So we'll see you very soon, and thanks again to all our wonderful panel.
Thank you.
Thanks.